Welcome to This Week in Money. I'm Jim Goddard. Today's show features David Morgan, editor of The Morgan Report, which focuses on silver and other precious metals. David reflects on what China is doing right now and how it could affect you. We talk to David Morgan right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is David Morgan, editor of The Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Jim, great to be with you.
We'll have a chance here to find out what David Morgan has to think about a lot of things, something that perhaps some people weren't ready to hear, but we know here's the guy who's on top of gold and silver, a great record of keeping track of what to do and what not to do with it. Perhaps, David, we can start the show with an overview of the silver market beginning to end.
Well, I was an avid precious metals fan for, several years. In fact, I went through the first bull market cycle back in the 70s that's accumulated to January 21st, 1980. And at that time, I was more gold-focused than silver. In fact, I asked the question, why the Hunt brothers decided to go in the silver market, not the gold market, and started studying silver more avidly than gold at that time, and that brought on several, very interesting aspects of the silver market. But moving on from this current beginning to the end, let me just say, one, I'm adamant about the fact that this bull market is not over. So as far as how it's going to end will be conjecture on my part. As far as the beginning goes, we had a bear market of 20 years from the high of January 1980 to basically in the silver market, it was September 2003. And I said, and in fact, I'd been around the world talking, lecturing about the silver market and the investment opportunities in silver, stating that silver, for one, was at the cheapest price it ever been in inflation-adjusted terms. It was it had done a formation of about the $5 level for roughly 20 years. Now, there were some times in and out of there that it moved up and down, and rather significantly. But overall, the main trend was very flat for a very, very long time. That's called a very big base. And so once that base breaks above the 555 level, no one knows how high is high. And that's a very accurate statement, because once these big base formations break to the upside, they can go quite extensively. And that's what happened in the silver market. It moved from the breakout point up to 840. And I was lecturing in, I think it was Calgary. I know it was in Canada. And I had a couple of guys that came up to me that were over-leveraged. It had shot up to 840. I asked, I didn't get the top exactly on that one. I recommended anyone that was using leverage to get out, I think around the 740 level. I forget exactly, but it moved up another day or so, and then it shot back down. It actually touched the 555 breakout point, and then it only held there for like a day, and then it started to move up again. So that was the first little spurt showing that, silver certainly can move up as well as down or sideways. And from there, the market moved and continued on its bullish trend, really, for quite some time. And we had a peak in the $21 level, and then we had the 2008 crisis that brought the silver market down below $9. And during that time, something very interesting happened. The precious metals were the first to bottom. Silver actually bottomed a little before gold. And the silver market, the retail market, was so strong that the supply could not meet demand. There was actually a shortage. It wasn't a silver shortage. There was a shortage of retail product, meaning 100-ounce bars, 10-ounce bars, 1-ounce rounds, 1-ounce coins, government-minted 1-ounce coins, those type of things. And there was a premium of like 30% or so. Most of the retail products, whether they were 1-ounce varieties of coins or medallions, or 10-ounce bars, or even up to the 100-ounce bar level, they were selling around $13.50. even though silver's price was around the $9 level or below. And that was for commercial bars, which is your poured 1,000-ounce bars. So there was an arbitrage opportunity, and I actually outlined that in one of my articles to the public about being able to arbitrage. You could sell your 100-ounce bars as an example, or your silver bags, your constitutional silver or whatever, and replenish that with the equivalent in commercial bar form and make the spread and come out with a lot more silver, come out with like 30% more, roughly, a little less than after paying fees. And of course, that's what happened. The prices did come together again, and we moved on, and then we got the next big move up, and that was a breakout around the $19 level, and it moved up pretty rapidly to $26 level. And at that time, it started to stall out, and I had shown what I was doing trading on my Morgan report on the Basic Plus service, where they can look over my shoulder and see what I'm looking at in the market. And I was long at 19, and around 26 I got out. And then QE2 was announced, and so I got right back in at the $26 level, and I rode it all the way up to 48. And I did get out within a few days of the very top, so I did a little better than that on the first one, where it was the 840 top. It was hard. I got out, luckily, on the way up, which is what you want to do, especially if you're long, obviously. And so the $48 top, and I was warning people on radio shows like yours, Jim, that, if you've got to buy silver here, be careful and don't buy it all. In other words, if you're going to buy, 5,000 worth, 1,000 worth, 10,000 worth, whatever, 100,000 worth, the point isn't the amount. The point is whatever the amount is for you to buy maybe half of it or, a third of it or something like that.
The old-fashioned advice, don't go all in.
Don't go all in. The market's too frothy. It's moving too fast. And I don't know if anyone heeded my words or not. I know a lot of people, because they came to me later, got out at the top. But so that was what happened, and we saw that. And since then till now, which is the part of the most current 3-year time frame, we've had 3 years where the market's been basically in a downtrend. And a lot of the big question really is this the end of a bull market, or is it a bear phase within an ongoing bull market? And I would argue that it is a bull phase within an it's a bear phase on an ongoing bull market. And technically it's that way too. I mean, I use technical work. A lot of people make fun of it or say it can't be done in a manipulated market and all kinds of things like that. But nonetheless, it does have its value, especially if you use it the way that I've finally learned after years and years, and that is to absolutely make the market tell you when to get in and when to get out. And that's a technique that I use and I show when I'm doing with these type of trades. So right now we're still in the doldrums. A lot of people lost interest, and there's a lot of people that are there's some on the sidelines, definitely. But the overall market has lost a lot of participants, particularly hedge fund types, and the market's been rather dull, and I can continue to see it probably being in the doldrums for probably through the summer.
The old sell in May, go away?
I think that's going to hold again this time, Jim. As far as the end of the bull market, as far as, where's the beginning to the end, no one knows exactly, but using the last bull market as a preface for this new bull market, Jeff Christian used to say, I don't know if he does anymore, but that 90% of the move comes in the last 10% of the time. And I adopted that and started using that because it was true. In fact, I gave a lecture there in Vancouver, BC. It was the first time I did it, where I actually looked at those words and did the math. And basically what happened, I think the move was like 92% of the move came in the last 7% of the time. Or maybe it was 89. So the adage is very, very accurate. Roughly 90% of the move came in the last 10% of the time. As a quick example, the last bull market in silver started about 1965 when the coinage was put into the slug format versus 90% silver coin. And then it ended January 21st, 1980. But it took from all of 1965 through an inclusive of 1978 to go from $1.29 an ounce to about $6 an ounce. So in that time frame, inflation was picking up quite a bit at the last year or two of that time frame, but you still had made money in real terms over that time frame, but it had taken you like 13, 14 years to do it. And then, let's say you were just a rank speculator and you didn't know any better, or maybe you did, doesn't matter your reason why for getting in the market, but you decided to get into the market. And you bought in January 1979 at $6 an ounce. Well, and let's say you stepped out at the top at 48. You had made 800% in a year, whereas the other investor that had held for 14 hadn't made anything near that amount. So the reason I want to emphasize this for the listeners is that, does that mean that that is going to take place this time? And the answer is, I don't know. That's the truth. I strongly believe it will. Number one, we had a pretty good look at how silver moves when it did that $19, $48 move. And I said at the time that that was a precursor to the ultimate move, the one I'm looking toward at the end of this bull cycle. I don't think that's going to happen until about 2016. Others, we all have our work that we do and our reasons for saying things or forecasting things. And of course, you should never give a price and a date because you're going to be wrong. But I don't know the exact date and I don't know the exact price. I do believe that we have a lot of overhead resistance to work off. We have a lot of people that bought silver at, 25, or really not many at that level. So let me say it more accurately. A lot of people have bought it in the 30s and 35 and a few in the 40s. So a lot of those people are discussed with the market, and when the market starts to finally come back up, there'll be people at the $26, $27 level that said, oh, that's it. I'm going to sell part of my silver. I bought too much, or I'm out and I don't like it. And then it finally works its way to 30. Or in the 30s, there'll be people say, I've held this stuff for 3 years, 4 years. I don't like it. I think the economy's fine, or whatever the reasons for buying it, or they don't believe them anymore, and they'll sell. So that's called overhead resistance. And you have to work through all of that overhead resistance before you start to make a new high. And a new high in silver would be, and this is a nominal high, not a real high on inflation-adjusted terms. So that's what we look forward to. But I do believe all that will happen, that we'll get through the what I call the breakdown level, both gold and silver this year, and that will be the $26 level on silver and about the $15.50 level on gold. I believe that'll happen 2014. And then 2015 we will work our way higher, and then in 2016 is when I really expect these rapid moves that we've already seen in the silver market. We've already seen the gold market. We saw them 3 years ago in silver, and we saw them September 3 years ago, so 2.5 or so, almost 3 in the gold market. And of course, we witnessed them in the bull market of 1980, and there's been a lot of information written about that people that are interested can look up on the web, on the internet. So it's not over. As far as I'm concerned, there's a long ways to go. I think the biggest gains lie ahead. I think it's going to be much more dangerous than the early days where it was fairly easy to get in and get out. But nonetheless, I think the biggest moves lie ahead of us. I think the biggest gains lie ahead of us. I think it's going to be trickier. You're going to have to really keep your emotions at bay, and you're going to have to, kind of listen to your own self, because, I'll be doing my best to get my people, filtered out. Don't expect me to pick the exact top, but only amateurs really try to get in at the exact bottom or the exact top. That's very much an amateurish type of a viewpoint to think that you can do that.
More with David Morgan next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with David Morgan, editor of the Morgan Report, which you can find online at silver-investor.com. Well, let's take a look at silver over the past couple of years, and how do you think this play is going to happen?
Well, Jim, as we were discussing in the first segment, we've been in the doldrums for silver in the last 3 years. I mean, a lot of people giving up. And there's basically 4 sets of investors, really, that look into the precious metals. This comes from a magazine called Bullion Magazine. It's a premier edition. It just came out. Some friends of mine in Australia have published this. And one of the analysts at Perth Mint has talked about it. And these 4 types are the Mad Max scenario, the speculator, the investor, and the insurance. And these are metaphors for the type of investor. But I think he's very accurate in his analysis here, and this is psychology, but psychology is really a very important part of the market. So your Mad Max type are the ones that think that the world's going to come to an end, things are going to be so disruptive that you're going to need, basically going to need gold and silver coins to barter. I mean, that's the Mad Max scenario. Now, and you can be more than one type. You can be a blend, but that's the type of investor that usually buys a small amount, usually continues to buy, and it's very, very strong hands. These type of people are going to hold. Probably they won't even sell at the top, or maybe just sell part or a small part. So that part of the market is kind of a very consistent and very strong part of the market, but it's not a very large percentage of the market. So the next part of the market is the speculator. And the speculator really has no care in the world about what the Mad Max type thinks. They don't think that the world is changing, or if it's changing, it's only changing for the better, and maybe there's a recession here or there, but they don't really buy into any of the philosophical ideas that the Mad Max type do. They are there for one thing and one thing only, and that's the profit. And they'll profit on the way up, they'll profit on the way down. They have no adhesion to the metals for anything other than for how much money they can make on it. It could be a day trade, it could be a week trade, it could be a month trade, or as I do on the trading side, it could be what I call position trading, which hopefully you're going to catch a major move and it'll be even months in duration. But nevertheless, the point is that these people are the type that are in and out of the market, and they can move the market higher than it would be if they weren't involved, or lower if they exit the market. In other words, the participation is important to the amount of volume that's in the market. And when they leave the market, because they are speculators, they will speculate anywhere. They're interested in money. So if they leave the metals speculation arena, they'll speculate in, let's say, the general equity market, or maybe a different commodity, or ETFs, or whatever. And that part of the market, Jim, is very much moved away. I mean, there's still speculators in the market. You can't, there's no such thing as being void of them. But the amount of them are less now than there have been in the past. And this is from the fact that silver and gold are basically moving sideways. And unless you're a very good bookmaker, excuse me, I'm making a little joke here, but there are ways to profit from it, and it's a sophisticated strategy and channel analysis. I won't go into it. I'm sorry, I digressed. Let me just get back on point. Unless the markets are moving, they're going to move away into something that is. So
I was going to say speculators like it when the financial charts look like an outline of the Rocky Mountains.
You got it. Exactly. So they're gone for the most part. A lot of them are gone. Then you have the investor. And the investor basically is the one that gets in early and holds for a long time, and they're hard to shake out of it. But a lot of the investors that are in the precious metals are already in. In other words, they have bought their position. A lot of them are still holding. Some have sold out. But there isn't a lot of new investors. There aren't a lot of people that are saying, you know what, precious metals is the way to go. There are a few that will come into the market. And I think, as I said earlier in the first segment, that when we start to really move, you'll see a lot of speculators, huge amount of speculators come in. You also see a fair amount of investors come in. Even the Mad Maxes will probably add to their positions. But right now, as it stands, a lot of the investors I would say they've left the market. They're just not adding to positions. So that market is lower than it once was. You could go through the 2003, 4, 5, 6. in that range, you had more and more investment. You had, you had the hedge funds, of course. You had some of the pension funds even that were buying into the gold market. And that, of course, continues on a nation-state basis. I mean, I'll call, China an investor. You've got the Shanghai Gold Exchange. So the East is still investing, but as far as, the personality type investor, they're pretty much stagnant. So we've covered the Mad Max, the speculative investor, and the last one is the insurance. And the insurance type investor are a great percentage of the market, and these are people that pretty sophisticated. They understand the market. They understand the basic outline of fiat money. They know that there's problems in the financial system, but they're not convinced that things can't either, one, be corrected or two, change or work our way through or whatever. So they take an insurance position, maybe a 10% position in gold coins or silver and gold. And it's a rather modest position. It allows them to keep the rest of their capital freed up for other ventures, other investments. And that's a vast majority of the market. That's where most people, where most people reside, as in the investment insurance policy part of the market. That part of the market is pretty stable, but again, like the investor, for the most part, they bought their positions. Most of these people that are in, and they're not adding. They're making money perhaps in the general equity market or other areas. They continue to hold. They're long-term. They probably will sell or sell part when they feel the time is right or they need to. But so right now, the two largest sections, the speculator primarily and the investor, have left the market for the most part. They're still there, but a lot less. And so now you're going to have some impetus to get people to come back in this market. The thing that gets people to come back into the market more than anything else is price movement. But it's a catch-22. How do you get the price to move when there aren't any new participants? And there will be a catalyst of some type. You can look at Ukraine as being one, but it really didn't do much. So it's going to take time to work its way through, but it will, and you will see people come back to the market. And now is really a time when most professionals start to accumulate, and people that want large positions, let's say there's a large bond fund, for example, that realizes what I've been advocating along with many others, kind of on the insurance position of why you should hedge. And that's because the debt situation is so bad. So let's say a particular bond manager decides to take a pretty sizable position in gold and decides that now is a great time to buy it. It's basically at the cost of production. But the amount of gold that he needs to buy to really do a proper job of hedging would be very, very large. And he knows how markets move. So because of that fact, what he will do is he'll put in a buy order daily or weekly, and he'll buy small chunks. They'd be big chunks for you and me, Jim, but small chunks relative to the position he's trying to accomplish. So he can't move the market very much. So he'll buy, and then the next week buy some more, and that's called accumulation. And that's what the professionals do all the time. You can actually see that type of pattern in the charts. It's called an accumulation pattern. And then at the top, it's called a distribution pattern. It's a little more prevalent in stocks and commodities, but it's in both. So that's the type of situation where this XYZ bond fund in 2017 says, even though bonds are down 10% for this year, our fund is up because we hedged our position in the gold market starting in 2014. Everyone says, well, I didn't hear anything about them buying gold in 2014. And that's right. They're pros and they're very quiet and they're not going to announce it. Of course, if it's a public company, they have to disclose it, in their financial statements. But even Warren Buffett, in fact, I digressed. This is one worth digressing, Jim. When Warren Buffett bought 129.7 million ounces of silver bullion off the exchange in 1999, the financial statement didn't list it as silver. It listed it as a miscellaneous investment.
Some miscellaneous.
That's right, because it's at law, if it's less than 2% of the holdings of the entire portfolio, it could be classified as miscellaneous. And the silver that he bought, although it was 20% of the above-ground supply, on the Berkshire Hathaway balance sheet, it was less than 2% of their total holdings. That should tell you something about the amount of fiat money that's floating around out there. 20% of the world's physical silver supply purchased, and he puts it down as a miscellaneous investment on their balance sheet.
Yes, well, Warren Buffett can do that.
So I think that's pretty much what I have to say about, the current market. It's going to, languish along, as I said that before, and then it's going to, for whatever reason, in fact, it may, when it pops, there may be no reason. Nothing. Well, there wasn't a war announcement. There wasn't this, there wasn't that. Why is it moving up? Well, it's moving up because it's moving up. It could be that simple.
And maybe Warren's making another miscellaneous purchase.
Could be the bond trader I just alluded to. Could be China buying more. It could be a lot of things. I mean, China's appetite into the gold market, particularly, is insatiable. They just keep buying and buying and buying.
Maybe we'll talk about what's behind that big buying spree. More with David Morgan next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with David Morgan, editor of the Morgan Report, which you can find online at silver-investor.com. So, David, what do you believe is the big push behind the Chinese snapping up of gold? And it's not really a snap up. They've sent a forklift truck out to every gold producer the last couple of years and hauled it all away. What's behind it?
Well, there's a direct correlation in the gold market between where gold goes in the world, and the gold always goes to the wealth-producing country. If you look at recent history, and you start with the great British Empire, you basically had the sun never sets on the British Empire, and what you had was they didn't really necessarily produce there on the island of Great Britain or England, but what they did was they had colonies, and they had the means of production through their colony situation, and basically they accumulated a lot of gold, a lot of wealth, and they were producing wealth. Well, that shifted to America, and especially after World War II, most of the world's gold went into the U.S. coffers, and now the main producer in the world is China, and they do not have most of the gold. It's hard, at least according to, I'm sure that they don't, but their official records certainly indicate that they have accumulated far more in the last couple of years than they had in the past, so they continue to accumulate. So that's just kind of an overview that, you can kind of follow the gold, and when you follow gold, what you find is that the gold always goes to where the highest wealth production rate is. Wealth is not a bank account. That's a representative potential wealth. Wealth is is tangible. It's, automobiles, it's houses, it's factories, it's in the Austrian school, it's the means of production. When you produce something that's wanted by the marketplace, you are producing wealth. An iPhone is wealth. Look at the Apple stock price. I mean, there's a lot of Apple products out there. They're wealthy. Why? Because they produced a lot of things that people want. It's producing something tangible that people want. So this is going on and will continue. And the shift, I think, will continue, because the big shift between the West and the East is that the West is declining at the same time that the East is increasing. And certainly there's problems in both areas, both in the West and in the East. But nonetheless, the shift or the general trend, I think, is very much in place and very much will continue.
When it comes to producing wealth, where are we going to get the food to feed all these people who are buying all these new things? I knew that the day China decided to become a consumer nation, 1.3 billion people deciding that they're going to buy cars and so on, I thought that's going to be the death of the U.S. Is it?
It's a really tough question. I certainly looked at it. I'll give you my opinion. If we back up and ask the question in a different way and say, well, what if China decided that everyone in China would have an American lifestyle? You'd have to back up and say, well, what's the resource base? And what you find is that 5% of the world's population, which is the United States, uses 25% of the world's resources. So that would imply for all the Chinese to have the same lifestyle as America, we need like 3 more planet Earths. And that's not going to happen. So then you start to ask the question you asked, Jim, is, well, where is the food going to come from? Where are the metals going to come from? Where are the plastics going to come from? Where are all where are the natural resources? Where's this extra Earth or 2 or 3 where is that? And of course you get answers like, nanotechnology, technology in general, all these things. And certainly that could help, but I don't think it solves the problem. So these are very big problems. I mean, there's huge problems in water, which is primary, how much potable water there is left in the world. You have problems with how much energy can be generated per capita. That's called energy flux density. The more energy per person that you have, the higher lifestyle you have. Nuclear is an answer. Some people like it, some people don't. Certainly with the Fukushima thing, a lot of people are rethinking the advantages and disadvantages to nuclear energy. Solar is almost a joke, and it's very important for the silver market, so I want to be objective here, but it's not a very efficient means of producing electricity at all. It's gotten better, and maybe it'll improve more, but it's certainly not something that, when you sit down and start to put in a new factory, the first thing you say is, let's go solar, we're going to save money, or we're going to be more efficient. That's not the way solar works at the present time.
Tidal energy is an area that's hardly been explored, and you take a look along the coasts of Canada, we have huge tides on both the east and west coasts, and how many people are making any money out of that?
Exactly, and you've got geothermal, which I think is a good solution. It's non-pollutive. It's all it takes is a delta T, a temperature differential, and you can produce power. I think it's something that's very much overlooked. There's some companies, in fact, one that we interviewed some time ago that does geothermal, but it's really an area that I think should be much, much more investigated and exploited, rather than some of the ones that we're most familiar with, especially the fossil fuel situation. I mean, the amount of oil that's burnt up each and every day is really, really phenomenal. And will it last forever? Yeah, probably will, but all the cheap and easy stuff is gone. So it's being harder and harder to get.
I can imagine 100 years from now, people will be saying, you actually burned oil?
Yeah. Yeah, I mean, anything that's plastic.
I mean, it's so useful, for so many other uses.
Exactly, that's what I was saying. I mean, as you know, Jim, like plastics, everything plastic comes from oil. A lot of the fertilizers. I mean, it's very, very useful, and it's very underpriced still. I know people might get very upset with me saying that, but a barrel of oil is worth 25,000 man-hours worth of labor. So I don't know anyone that you can't pay 25,000 people $100 divided by that 25,000 for any length of time. In other words, it's going to be too low a wage rate for them to accept that in payment for an hour of their time. Even the worst off in China isn't going to do that. So it's very, very underpriced relative to what it represents as far as work energy is concerned. And people don't think about that. They go tooling down the road in their automobile or hop on an airplane or whatever. And I don't want to be a hypocrite. I do that. I mean, let's be real honest here. But I do think about it probably more than the average person of, how much energy am I using to do this? I mean, this is something that really didn't happen until about, 1900 or so. So we've had about 100 years where the Western world particularly is basically taken for granted, Europe as well, that you just pop in a car. And of course, the underdeveloped nations, I mean, I travel the world fairly extensively. There's lots of places I have not been. But, South America, into Hong Kong, where else? Singapore. I mean, any of these countries I've been to, I mean, it's just a mad traffic jam everywhere. They're all burning fossil fuels. They're all running around. I was in Panama recently, and, the city was very, very crowded with automobiles and buses and that type of thing. It smoothed out when I got out to the coast. But this is the way of the world. And, again, most people, I think, don't stop to consider how precious a resource it really is. As you said, Jim, coming back to you, in the future, you're going to see how you did what with this? You didn't have any restrictions on it, or, there'll be lots of questions about what were you thinking? Didn't you see this coming? And all that goes back to, how you're going to feed all these people. Well, this weather situation that we have globally and the droughts in the Southwest, a lot of the breadbaskets out of the United States are very much in danger of not being able to produce nearly the amount that they normally do. So this will play into it as well.
We'll have more with David Morgan next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with David Morgan, editor of the Morgan Report, which you can find online at silver-investor.com. Weather, the drought in the U.S., people are asking why steak prices are so high this barbecue season. Is that something that you have to look at when you're advising people on where to put their wealth?
Yeah, absolutely. I mean, all these things are interconnected, and, one affects the other. I mean, water, as we talked about, is very important. Without water, you can't grow food. And with this drought situation, and I think it's going to have bigger repercussions probably next year than this year. I think you're going to start to see a subtle increase in food prices, which is already seen, but it'll be, it will continue. And I think you're going to look back a year from now, and everyone meaning the Western Hemisphere, and probably globally, is going to be pretty startled on what food prices really are.
Are we going to end up for real with the Hunger Games?
I don't know. It's possible. I mean, a lot of these big upheavals that have taken place globally are not about, we hate our government, although that's the way it's portrayed in the mainstream press. It's really about food. It's about food prices. They cannot afford to eat. I forget the exact equation. It was done by Chris Martenson recently in an interview of his that I listened to. And I think it was when 40% of the population devotes 100% of their income to feed themselves, and they can't, that's when they get out in the street and riot. And you've had this in Egypt, you've had it in other areas because of food. But again, it's not something that you'll listen to on the mainstream media telling you the truth. That's why these people are out in the street. It's because bus fares or something. No, it's because they want to eat and they can't. So this is already happening, Jim. And is it going to happen more? And I say yes, the trend is in place and it will continue.
So the next war might not be over oil or something obvious like that, but something as basic as having enough for breakfast.
Could be, absolutely.
Eggs and chickens. In Vancouver now, the mayor allows people to have chicken coops and beehives. And we're not overrun with chickens or beehives as far as I can tell so far. But that could change, couldn't it?
Well, it depends. I mean, you can play out the scenario any way you wish if you want to take it to an extreme, and I like to think in extremes because then it keeps me balanced, or hopefully balanced. I mean, if everyone in Vancouver wanted to, be a beekeeper, obviously you'd have too many. So it'll strike a balance. Same thing with chickens. But the idea, I think, is actually a little forward-thinking in my mind because the trend is there, and how bad it'll get, no one can really say. But why not offset it? I mean, if you go back to a real concrete world example, which is a good way to look at it, when you had the quote-unquote failure of communism, you had two scenarios. You had the North Koreans that were totally dependent on the Soviet Union, and they said, help us. And they starved. The North Koreans starved. Not everyone there, but the population starved. But Cuba, who was also dependent, their leadership did something totally capitalistic. They said, every piece of land out there that you can find, go and grow food on it. And they thrived. All of the parks, all of the areas that had open space, they planted and grew food. And in the second year or so, they were actually eating better than they had before ever. Same problem, different solution. So and those are concrete examples. You can look those up. So that's the idea that, make people a little more self-sufficient and you're going to do better.
Well, you're right. Vancouver is ahead. They have community gardens all over the place. If there's a vacant lot, everybody in the neighborhood can have, a row of vegetables. And if you say, well, it's not a lot of food, even if it saves you a month's worth of buying fresh produce, at today's prices, that's a lot of money.
Absolutely it is. And it's, 12%. I mean, 12% is a big number, I mean, if you didn't have to buy any groceries for a month, that's a pretty good deal, as you just alluded to. And it could be more than that. I mean, really, I think you're going to see more and more of that. I think that's the trend.
Isn't that what 3D printing is industrially, growing your own?
Yeah, Yeah, it's a good analogy. It is.
And how realistic is that? I hear people saying it's the wave of the future and the giant factories of Asia will shut down. And others are saying, well, no, those factories will just custom produce things for you, but you still won't do it yourself because you won't want all that messy, gooey stuff in your house that you need to produce it with.
Well, it'll be both, but I'm not that studied on the topic, and I haven't really given a lot of thought. But I think that it'll be a combination. You'll have some places that will be big things, that will be custom jobs, and there'll be businesses built around those. And then there'll be, the wealthy at first that will be able to afford the smaller ones that will have them in their homes. But it'll be a combination, I think. But it is going to definitely disrupt. I mean, the technology, I don't rule out the technology being able to solve all our problems. I doubt it. I mean, I'm a realist and I'm an engineer. I mean, basically before I went on for my business economics degrees, but I don't see a lot of these larger problems being solved quickly enough. And so the way they'll be solved is a reduction in lifestyle. You'll eat less, you'll live in a smaller home, you'll drive less, you'll do less of what you're doing now because the economic conditions are such that it demands that your lifestyle change. And I'm not even convinced that that's such a bad thing. Speaking for myself, I think that, we've been pretty spoiled and pretty wasteful. And when the economic conditions continue to deteriorate, or let's say, I don't want to say deteriorate, they just demand that you change your behavior, perhaps that, again, might not be the worst thing, when you don't take any old trip, any old time for any old reason.
We have people protesting in Vancouver against the building of new pipelines out to the coast, but how many of those people drove there or are wearing shoes with rubber soles made from oil? I don't know if some people actually think about it.
I think very few do. I really think deeply about it. I mean, we're basically all in this thing together, and it is all about resources. And it's really, the question to me is, what is the most equitable, fairest, best method of allocating resources to people in general? And boy, that's a tough question because that's mostly politically based. And the politicians, in my book, don't seem to be able to do a very good job at anything. So you really want it to be more of a technological question. You want a bunch of engineers and scientists to decide how much resources there are and what's the best means to produce and what's the best allocation model, or at least come up with a database of, how much resources are available currently per capita, per person. But I don't think you're going to ever see a politician go that model.
Well, as you know, a politician's number one job is to get reelected.
Exactly. So they'll promise things that can't be delivered, and of course that will make the problem even worse. But the economics is economics. It's human interaction. And prices are going to arbitrate what you can and cannot do. And if, for example, gasoline prices get too high, people will drive less. It's just a fact. If food prices get too high, a lot of restaurants will be out of business. So these are things that, I think will take place in the future. There will be, life is changed. Change happens, and it's going to happen in the future. And I think a lot of it will be a lowering of lifestyle, the basic things that perhaps we take for granted at this point in time.
And as you've said, having a nice hedge behind you, perhaps a little gold and silver, could be a good idea at the same time, too.
I think so, definitely.
Thank you very much, David.
Thank you, Jim. It's been a pleasure.
My guest has been David Morgan, editor of the Morgan Report, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.